In this video, I'm gonna share what I think is one of the best investing methods out there. Buy and hold forever. But don't trust me, trust one of the world's best investors, Warren Buffett.
It's much easier to invest for the long term if you're just talking pure investment, because you know what's going to, in my view, be very high probability what's going to happen 10 and 20 years from now in a major way, and I don't have the faintest idea what's going to happen tomorrow or next week.
Hi folks, my name is Philip and this channel is all about buy and hold stocks as lived by the stock miracle Warren Buffett.
I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important.
Let's begin with why stocks. If you would have invested $1 in 1802 into the stock market with an annual growth rate of 6.8%, you would end up with $1.3 million in 2011. If you would have done the same thing with bonds, you would end up with 1.6 grand. With gold, you would have $3.26 nowadays, and if you invested $1 in 1802 in dollar, you would end up with less than 5 cents. That's a negative growth rate of minus 1.4% per year. Now that it's clear, the stock market is the biggest opportunity to multiply your money. It rose since at least 220 years, and it doesn't seem to stop. There's a saying on the stock market: the stock exchange is a betting machine in the short term and a scale in the long term. Since it is practically impossible to foresee a short-term development in a share, but it's possible to calculate which company is and will be very good in the future.
Number one rule of Wall Street: nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles, least of all stockbrokers.
Let's create two scenarios. The first is based on a short-term investing strategy. What I mean with that are periods of time smaller than 10 years. For example, if you bought shares in 2000 and sold them in 2010, you would have lost 2.34% of your money per year. Now you could say, I would have bought the shares at the ditch in 2002, 2003, and sold them at the top in 2007. But this is very unlikely because of two psychological effects. The first is why you are most likely to buy stocks near the peak. It's the fear of missing out at a stock market peak. It seems everyone around you is getting rich except you. And when you finally buy those stocks, they are going to collapse or decrease in the next months. And then, when they are decreasing or collapsing, for example in a recession, you are losing money every day and it gets worse every day. Also, everyone around you is full of fear and the news are full of fear as well. So you can't stand it anymore and trigger an emergency sell to stop losing money. But what's really happening? You lose a lot of money, and if you would have not sold those stocks, they are rising again a few months or years later. Those actions based on emotional decisions are the biggest mistake in the stock market. And as a short-term investor, you're totally delivered to them. But as a long-term investor, those things aren't even bothering you. This is why so many private investors are losing money on the stock market. Don't be one of them.
The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow.
Okay, now the second scenario. This is a long-term scenario. You bought shares in 1980 and sold them now in 2021, around 40 years later. You would have added 2,800% to your initial investment. That means a growth rate per year of 9.24%. And what's really interesting, it doesn't even matter when you started investing. If you just kept the stocks long enough, you will have an average growth rate of around 10% per year. And this is just the overall development of the stock market. If you would buy single shares of wonderful companies, your average growth would be a lot higher than 10% per year. For example, the annual returns of Warren Buffett are around 20%.
I bought my first stock in April of 1942. I was 11. Pearl Harbor had happened 3 or 4 months earlier. We were losing the war. I mean, if you want to talk about a bad outlook for the country's not going to go away. The plants aren't going to go away. The people aren't going to go away. The talents aren't going to go away. The country will grow in value.
Okay, now we know why everyone should invest long term. At first, the growth opportunity is a lot bigger and the risk is so much lower the longer you keep one investment. But when should I buy a stock? Basically, if you invest over a long time period, it doesn't really matter when to buy a stock. It's important to choose the stocks wisely because you want to have wonderful companies because you will keep them the next 20 to 40 years.
So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
And no position in your portfolio should be bigger than 10% of your whole investments. With that, even when one company files for bankruptcy, it's not that big of a deal for your whole performance. But keep in mind, the more you diversify, the lower your return if one individual stock is skyrocketing.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come.
But when should I sell a specific stock? You should basically never sell a stock, no matter what's the current value. The one situation where you should sell it is when something big in the company or in the marketplace of the company changes in a negative direction. For example, the management is no longer honest, or there is a ban on tobacco products, and it's the main business model of the company to sell tobacco, or the earnings of the company are decreasing.
Our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens.
There are 2 ways to even more increase your revenue. The first is to just add a fixed amount of money every month. For example, you start with $10,000 and invest $150 every month with a growth rate of 10% per year. You will end up with $484,000 after 30 years. But there is another way that's even more effective. When the price of your stock is really high, you sell a little bit of your position. Let's say you have $10,000 worth of Apple stocks and the current value is really high. So you sell 5% of your stock. That's $500. Then you keep the cash and reinvest it when the share price drops down. With that, you get an additional momentum and your earnings will even more increase. Now you should understand the whole process of long-term investing and why it's a lot safer, and you also know a few tricks to increase your revenue even more. Thanks for watching. If you enjoyed the video, please subscribe to not miss any new video and to support